I mean, for sure, like, you can study anything. I think one of the cool things about banking is it is extremely it's an extremely open-minded career. Like anybody can do banking. So I have people who studied like English language that work with me. People who studied like aeronautical engineering. I
Nice.
think the person that sits down beside me studied like physics or something. And sometimes I'm like, how did you study physics? And you are here like at 2 a.m. with me, like I mean, be for real, like you know.
So, we invited the man in finance that everyone's been looking for on social media.
I'm looking for a man in finance, trust fund, 6'5", blue eyes.
Our guest on this episode is Adebayo Adegbenro, an investment banker who's currently an associate at Bank of America. Ade takes us on a journey into the world of finance, exploring what drives startups and businesses. We also discuss growth stage investment and fundraising, as well as how companies in the Techosystem should approach product strategy and scaling. All right, enjoy the episode.
Hello everyone, I'm Emmanuel.
And I'm Chuka.
And you're listening to Inside the Techosystem podcast, where we explore Nigeria's tech landscape, one conversation at a time. Hey, ITT fam. You're welcome back to the show. Chuka, how are you doing?
Man, it's been an eventful week.
You have to explain yourself now, right?
Yes. This is usually my line, but like you're asking me now, I'm very excited. You're asking me how's it going? How have I been? Hitting the gym. I'm playing basketball more these days. Focusing on my mental health, my mental well-being. I can't complain. It's been great. How you been, man?
I'm not sure you can have it all. Like play basketball, go to the gym, and also have your mental health. Like you can't have it all. No. I'm sure your mental health is not okay.
Not completely, but we're working on it. Not completely, but we're working on it.
Okay.
So
when you work on it, then you stop playing basketball or you stop going to the gym. Yeah, one has to go.
Jesus. Nah, don't do that. Don't do that to me, man. How cold is it right now in Amsterdam?
So it is 6 degrees. Last week and this week have been cold. But 2 weeks ago, it was 20 degrees. So the weather is really confusing here. But from this weekend, it's going to be like 20 degrees and above. So summer is almost here. So
is it spring or not? You guys don't have spring. I don't understand what's happening.
So it is spring, but it's very, it's very unpredictable. So on some days you get 20 degrees, and some days you actually get as low as 5 degrees or less.
Man, so I'm glad you guys didn't trick me, because when I was around, you guys kept saying, "Don't worry, spring will soon come." I'm like, so spring is here, and you guys are still experiencing that weather. Nah, man, I can't do that. Congratulations to y'all.
It's very unpredictable. Yeah. So today is just another special episode. I know we always say this, but we always bring in superstars on the show. And today we brought another superstar. I don't want to say another because then it makes it less superstar-ish. So I would say today we brought a superstar on the show. His name is Adegbenro. So fun fact, he has Ade in two of his names. In today's episode, we're really going to be talking about a lot of finance things, product scaling.
I'm excited.
Lots of things that tech bros don't usually talk about. So today is going to be like more on the product and finance bro-ish side. And now I've said ish in the last 4 sentences.
This is Emmanuel's domain. Emmanuel is a finance guy. So I love
Emmanuel thinks he's a finance guy, but he's not really a finance guy. But anyways, so Ade, welcome to the show.
Welcome.
Thank you guys. No, man. Thank you guys, for having me. Really nice to finally be here. By the way, you guys are doing amazing. Like, the podcast is incredible. Like, what you guys are doing is
Thanks,
just
man.
phenomenal.
Thanks,
So,
man. That means a lot.
well
That
done
means
on
a
all
lot.
the good work.
Thank you.
Thanks, man. Thanks.
So to start off, let's talk about how you go into tech, because that's usually the first question that we ask our guests. Tell us how you go into tech. Tell us how you started. You can go as far back as when you were born. We like to know everything.
Yeah, no.
And tell us more about yourself. Emmanuel did a great job introducing you as the finance guy, but like I know there's more to you, so let us know.
For sure.
Yeah, no, for sure. And again, like, guys, thank you for having me. So I suppose, like, as a bit of an introduction, I currently do sort of VC/growth equity investing at like one of the sort of biggest investors on the continent and actually globally as well. But I work out of like
Flex. Okay.
but I work with a team back in Africa out of Nairobi, and that's because I am very long sort of Africa and I'm very long the continent, just more broadly. And then before doing that, I used to do investment banking at Bank of America. So I was doing fintech investment banking, helping some of the big fintech names that raise capital, do M&As, and just do like all of those financing, all those fancy things that you then read up on like TechCrunch later. And then, that sends some founders into depressive episodes because someone has raised like $20 million and like they haven't raised anything. And so I did that for a few years. And then before then, I did something very unconventional. I was actually working in private equity, like actual like infrastructure private equity for a firm for Africa infrastructure investment managers. I did that in Lagos and Abidjan in Cote d'Ivoire. But like from a tech perspective, I suppose my career really began when I was in university. So I went to University of Lagos. And when I was there, I founded like the Investment Society, which is like the first undergraduate investment society in Nigeria.
Oh, nice.
And I know this sounds very like investment, financy, but like ultimately what we're also looking to do in addition to helping members get internships and get careers at like the big sort of firms, we also had like an alternative investment decision or alternative investing division rather, where we did like VC and then like small kind of VC deals. We help businesses on campus raise money. We help them sort of put together business plans and then reach out to investors as well. And we also help our members also prepare to become like VC investors. And so it's actually funny because the person who took over from me as president went on to start our own career like in VC investing as well, at one of the biggest VC firms on the continent. And that's something that I was able to sort of help start in university. And then when I was there, I also worked with my friends to do this startup called Kanja Drive, which is like a very sort of, we're using AR, augmented reality and virtual reality sort of solutions to simulate driving in Lagos. You know how driving in Lagos can be like, how insane it can be. So wanted to like solve
I
problem.
don't think I can relate, but I can relate.
I mean, yeah, like
well, fun fact. I learned how to drive this year. Yeah, I'm done. I'm done with my classes, so I just did my license.
Congratulations.
Yes, I'm an old man that just learned how to drive, but I'm glad I did.
Congratulations, congratulations! Because driving in Lagos that thing is another level of skill, right? Yeah, so we did that, and I thought that was really nice. But obviously, like for me, like the way I see technology is just really about solving problems. But like from like an actual technical tech perspective, I would say that was like my first sort of foray into building startups. And then afterwards, I think in 2019, 2020, I joined the Thrive Africa team to help start funding businesses, doing like VC on the side. So I've been doing that as well for the last sort of 4 or 5 years now. And so I also, worked with my friend's startup and Nomad Integrated, did that for worked with them, raised money on the board. And I've basically just sort of been supporting them since then. I suppose most recently, what I've also been doing, helping to build products, has been at this startup called Barrel. They've recently just launched a few months ago. So we've been trying to sort of go to market with the product, trying to achieve scale with the product, and also basically just grow the product globally. So I suppose at this point I'm wearing so many caps doing products on the Barrel.
I'm just thinking so many things you're doing.
Yeah.
You mentioned infrastructure, private equity, and the first thing that came to mind was Adebayo Ogunlesi, because his firm basically does that, but like on a much larger scale. I actually watched a talk from him. Someone asked him why he's not investing in Africa, and then his answer was quite interesting. I can link
Oh,
I
wow.
can link the I can
Please,
link
I'd love to know the
interview.
answer.
Oh,
Basically,
yeah,
he
no, for
said the
sure.
Nigerian government is not serious.
Ooh,
That's what he said.
Oh.
wow.
But anyways, just find it
Ade, what
interesting.
do you have to say about that, please? I'm very curious.
I mean, like,
Because
what
you
else?
are
Like,
investing, so
like, what can I possibly say? Like, the man himself has spoken, so like, I'm not sure what else to say. But to be fair, I don't think that I don't think that the Nigerian government is serious about infrastructure or about like building infrastructure in the country, and so there's only so much you can do because you have people like Adebayo Ogunlesi who are like sort of pioneers, right? Like they are basically like building things globally, and like the East Nigerian, for example. I mean, I do not think that like he would not invest in Nigeria if the opportunity was right. So clearly, like for him not to invest in the country or for his family not to invest in the country, something must clearly be wrong. And if he says the government is not serious, then to be fair, I agree with
And
him.
then the government is not serious.
Then the government is not serious, basically.
yeah. So Emmanuel, did we cut Ade short? I think he was trying to tell us some more things about startups and his work so far.
Yeah, I mean, to be fair, I think that's about it. So I was saying I'm wearing like a number of caps. So basically doing all of this product work, doing financing as well, and then doing VC, doing investing. And I suppose like I really like all of this. So I like being like an operator. So actually working, taking on an operating role, doing something on a day-to-day basis, and also sort of investing. And so from like an experience perspective, I would say I work at the intersection of financing and operations. And so I have seen things from both sides. And what we find today is like a lot of people have done maybe like just one. Some people are just like VC investors and have never worked in an operating role before. Or some people have basically worked as operators and now they're trying to move into VC. But I do think that like people who are a bit more versatile, like with their experiences, can offer a lot more sort of value.
I totally agree with that.
And that's what I'm trying to optimize for ultimately.
Okay. They're also trying to retire as early as possible.
Do you understand? Like, do you understand? Optimize everything.
What are some of your favorite industries to invest in at the end of the day?
It's a very good question. I'm very biased towards fintech because obviously I've done fintech. I've spent a lot of time, working with fintech. I think that again, I've also seen that everybody has money issues. Like money issues is just like rife, especially amongst many young people. Like we are all so constantly stressed about money for some reason. And so, having people help us solve these problems, like with either new products or like new sort of designs or new, I don't know, like new whatever it is, like definitely makes me, excites me. So I do like fintech. I think it's very interesting. I also really like just sort of B2B SaaS products as well. I think that I think, they help solve problems for organizations and they are, they can be scaled very easily or like to a large extent. Scalability is quite easy with them. If you have like a very good sort of go-to-market strategy, you have a very good team, you have a very good marketing plan, like all of those things in place, then B2B SaaS is quite cool. It can be very, like, it's also a very competitive industry. And so people are constantly innovating, which I also really like. And I think is interesting. And I suppose like more recently, I also really just like all the possibilities sort of like with AI. And then like AI is like, I wouldn't call it a trend. It's like a force that's come to sort of stay now. And within the AI spectrum, just a lot of industries will get disrupted. So I'm very excited about all of the disruptions and all of the changes and efficiencies that would come through the adoption of of artificial intelligence. So if I were to put them into buckets, it would be fintech, sort of B2B SaaS, more broadly, and then like just AI solutions would be
Okay, cool.
I find interesting.
I feel like your bias towards fintech comes from, doing investment banking at Bank of America. And this is a very interesting start, but you are apparently the first guest that we've ever had that has worked at Bank of America. Emmanuel, if I'm wrong, please correct me. I don't think I'm wrong. Okay, great. So what's a day in the life like of an investment banker, right? I want because I don't think I've spoken to many investment bankers, right? And I know it's not something you do actively like you used to, but during that time, what was it like? And what was it like working at BOA as well?
Good question. Firstly, and this is what everyone is going to tell you, and it might sound like a very cliche answer, but like no 2 days are the same. So like there's no typical day in banking. It's every day is just like a different kind of madness, and so you have to be able to adapt to all of it's just chaotic. It's just chaos from like everywhere, and so you just have to be very fluid. Like you must be fluid enough to adapt to like whatever madness or chaos is thrown at you. But I would say like a fairly typical day for me would be to wake up. I usually wake up fairly late, so like 7 a.m. On days where I've gotten like a very good night's sleep, I'll probably go to the gym for like 30 minutes or, just go to the office. But I usually try to get to work by 9. Often you would have calls at say 8:30 or 9 a.m. or like 8 a.m. in the morning. And these calls are usually maybe like client calls. So if you're working on a project, for example, you're helping a client raise money, or you're advising a client on an M&A, for example, you might have a call with the client in the morning. And then you go into the office at say 9 a.m. And from 9 a.m., you probably have for me, I'll probably have like other meetings during the day, or like other sort of client deliverables during the day. So I'll start putting those together. And what are these client deliverables? I'm probably building like a model, like a measure model, for example, or like an operating model for a company that wants to raise money. An operating model is basically you model the entire operation of like the company. So this year, this company is going to make revenues is going to be $1 million. But to get $1 million in revenue, they have like XYZ product lines. They sell phones. So we expect that every day they're going to sell 2,000 phones. So 2,000 times 30 days a month is going to give us like total sort of amount of phones sold in January. They also sell chargers as well. So you basically break that down by month and then by year, and then you forecast that to then, sort of.
Is this always accurate?
I mean,
No, it's the forecast, right?
It's just a forecast. So like it is hardly ever accurate, but like you always try, and that's why sometimes you also have calls with like research. So if you're doing something for like a client that you don't really know a lot about their business model, you might have the call at 8 a.m., for example, with the CFO to be like, okay, can you give us input on like what you've done historically, so we can use that to build a model, and then you can have that call in the morning, so you can build a model like in the afternoon and then send it back before like the meeting. So you basically build your operating model. And then when you build your operating model, obviously you also have to do like a presentation, make it fancy, make it beautiful, add nice colors. So they know like you're a very serious person. And then you do all of that. And then, you probably send it out much later in the day to like your seniors to review for you, or to review like the model you've done, or to review the numbers in the sheet. They'll ask you a few questions. So why are you projecting this? Why are you projecting that? So you do that. And then around lunchtime, say at like 12 or 1, I usually just grab lunch. Sometimes if the weather is nice, like next week or like 2 weeks ago, I'll probably just grab lunch outside and just sit outside and, like with my friends or colleagues. But if the weather is really shit, like today, for example, I'll just grab lunch and eat at my desk, and then do that. And then you send out, say, like the model to like your senior, or to like an MD or a director or a vice president, who is most likely who you send it to. Then they review the numbers. They're like, actually, these numbers do not make much sense. Can you tweak this? Can you tweak that? And so you have like that back and forth over the numbers or over the presentation as well. And then you might do that until like, say later in the day, say like 6 or 7 p.m. in the night. And then you can then send to the clients. And then sometimes the clients get back to you at like 8 or 9 p.m. and says, okay, yeah, your numbers make sense. But like, can you also add XYZ into the model? Can you make sensitivities for this? Can you run scenarios for this? Can you do,
Yeah.
so you basically talk through the numbers. But mind you, this is just for like one client, right? And you might be doing this for like 2 or 3 clients. And so you're doing all of that together at the same time. And they're all due like
that's
on
stressful.
the same day.
That sounds stressful.
Yeah.
But like the
so-
clients, are you usually talking to the finance person on the client's team, right? Rather than the client, because, not many CEOs may be able to like, talk about the numbers, right? But they may have a finance person that, you'd liaise with. Is that how it usually goes?
Yeah, I mean, so usually you would talk to like the CFO or like whoever is in like finance or like the finance numbers. But you realize that like one of the things with like doing deals, right? So like imagine like you are like you are a Klarna, for example, or you are like a Monzo Bank, or you're like a Revolut or whatever it is, and you're trying to raise money from investors, right? If you're trying to raise like, I don't know, like 20, 30, 40 million dollars or $50 million, this is like, you're going to market to like market yourself, from investors. So this is not just a CFO job. This is like a CEO job, because like you need that money to come into the company to like do whatever expansion you want to do. So, as part of the entire deal process, right? You might engage with the CEO and like maybe CEO on some conversations. And for certain conversations, like just like financial nitty-gritty, then you would engage with like the CFO. But from like a broad strategy, how much are you looking to raise? How should we structure your equity story? How should we craft your equity story? What kind of investors do you want to meet with? What kind of investors do you want on your cap table? When you're having these conversations, it is usually with like the CEO or like the CEO or like more sort of top rank people. Yeah. And so if you're doing like a number of these deals at the same time, you might be speaking to multiple people within the company, right, on the same number of things or like on the same project. And as a banker, as a junior banker, right, like you're doing like 2 or 3 projects at the same time. So there's just a lot of things coming to you, and usually they are due like on the same day. And so in this case, say you have to build like 3 different models. You have to put all of the models into presentations. You have to then send it out to like your associates or like your VP to review. And then when they review, they're going to send you comments and you have to like sort of walk through. And so you can do that until 2 a.m. or like 12 or 11 a.m., like 12 a.m., 1 a.m. or 2 a.m. or even 3 a.m. in the morning. Because if you have a meeting by 8 a.m. in the morning with the CFO, then it means you need to get everything ready, right? Mm-hmm. Everybody on the team, like at Bank of America, must have checked that this work is good, this work is great, this work makes sense. And then you now send to the CFO so that when the CFO wakes up by 6 a.m. in the morning, he can go through what you've sent to them before he gets on the call by 8 a.m. So it's...
So what was your sleep routine like?
Oh man, this is, I don't know. I mean, on average,
I might awake me some certain traumas. Like,
you are definitely like rekindling like all the traumas.
I'm sorry.
No, it's fine. That's right, guys. Investment banking is not scary. You guys come and do banking. It's beautiful.
Oh my god,
it's awesome.
It sounds like a trap.
You're gonna get 8 hours of sleep every night, guaranteed. Like, when it comes on 8 hours for sure.
Oh man.
But like sleep cycles are like they're not guaranteed at all, like in banking. Yeah. So I would say like on average, people would do like say 4 to 5 hours of sleep. And when things are really chill, probably do like 6 hours. And so it's if you leave the office by say 12 a.m. and you can sleep till like 6 or 7 a.m. in the morning, then that's great. But that's the thing. It's like if you leave the office by 12 or 11, you are not.
Sorry, like, did I hear that right? 12 a.m.
Yeah, in the morning. Yeah, 12 a.m. Yeah.
Like you leave the office not 10 p.m., not 11 p.m., 12 a.m.
No, I'm just saying, like.
that's even beyond what we do in tech.
No,
so like
that's insane, yo.
What do you have to do to become an investment banker? I'm not just talking about Bank of America now, because like from what you're saying, can someone study accounting in university, like a university in Nigeria, and then go ahead to become an investment banker, depending on what path it chooses in life? So how does one become that? Like, what do you have to do?
I mean, for sure, like, you can study anything. I think one of the cool things about banking is it is extremely like it's an extremely open-minded career. Like anybody can do banking. So I have people who studied like English language that work with me, people who studied like aeronautical engineering.
Oh,
I think
nice.
the person that sits down beside me studied like physics or something. And sometimes I'm like, how did you study physics? And you are here like at 2 a.m. with me, like I mean, be for real, like you know, like do more with your life. But again,
man. Valid question.
different people do different things. So like people from like all sort of backgrounds do banking. Because again, like it also gets very technical. I'll give you an example. Say you were doing like you were like on the what's the team called now? So we used to call the team power and utilities. So basically they do everything from like power, utilities. So things from like power plants, oil and gas, extraction, mining, those kind of technical and industries, right? If any of those technical, if anyone in those, so if any of the companies in that industry was looking to raise money or to acquire another company, just given how technical and specialized they are, you need people who understand the industry, who understand the lingo to be able to build the models, to be able to like write the reports on the industry, right? Like you won't just take like a finance sort of, undergrad to go and meet with like the CEO of Shell.
I see similarities with tech because for engineers, for example, if you're building an industry, you kind of have to understand the industry. So if you're raising capital for an industry, then you also need some level of knowledge there as well.
Exactly, it's important. Yeah, I mean, same thing with like pharmaceuticals as well. Like if you're like in healthcare and you studied English language. I mean, you can learn, but it's going to be like an uphill task for you compared to someone who studied, say, biology or like studied medicine, right? Mm-hmm. They understand the industry. They understand how drugs work. They understand all of the jargon. So again, anyone can get into banking. And then for me, it was, so when I was in university, I did an internship at Goldman Sachs in London. And then in my second year, and then in my third year, I did another internship at Bank of America in New York. And then I got an offer to return to the bank in London, which is what, I then did. And then I joined them. And how did I get these offers? They basically came to the university. So they had like a program. So they flew down to Nigeria. They came to campus and spoke to us. They brought people who had done the program in previous years. And then they spoke to us about the process. There was like an interview process that we had to go through. And so you basically prepare for the interview and you show that you're interested in doing it. And then, you get in.
I'm glad we're speaking to you about this because not a lot of people know that these opportunities are available to them because you went to university in Nigeria, right?
Yeah.
Yeah. And then, you went on to do, intern at all these places, right? And I'm pretty sure Emmanuel would know that, maybe Goldman Sachs or, some other.
They also did that in my school as well.
Yeah. But personally, this is the first time I'm hearing of BOA also like, doing something similar, right? Yeah. So is this still going on currently? Like if people are looking to maybe do something like this, intern at these places in the future?
Oh yeah, for sure. Like, I mean, definitely. Like, I think now you even have like a lot more opportunities. Because at the time I did my internship at Goldman, the only way you could get into Goldman, at least in London, was through the spring internship program, which was run by SEO Africa. And so SEO would conduct all the interviews. And those interviews are like really, really rigorous, right? So they'll conduct the interviews and then you then go to London, you do the spring internship, and if you do well, they extend you a summer internship, and then if you do well, they then give you like a full-time offer. So like there was like a tiered process that you had to go through until you eventually got the offer. But then I think the year after I interned at Goldman, then Goldman had this Africa recruiting initiative where they then actually come down to the continent and then do like recruit directly for like summer internships and full-time roles. Bank of America on the other hand, you just do like summer internship recruiting. I don't think they have any full-time recruiting presence on the continent. But I think in 2019 or 2020, something changed and a lot of firms started accepting like applications from Nigeria directly. So, at least like within tech and even within finance, like firms like JP Morgan, Bloomberg started recruiting directly from like Nigeria and from Ghana. within tech, I have friends who recruited directly into like Meta, into Snapchat, into Google, into like Microsoft from Nigeria. And like this wasn't
I like
something
that.
that
like
was
that.
popular like prior. So
Mm.
it's good.
That's really nice. What was it like actually raising funds? So let's start from the perspective of the investor, which I think you are on that side, right?
Yeah.
Not directly, but indirectly.
Yeah.
So someone wants to raise money, and how do you start? How do you start the process, and what are the steps that you would? For example, you might probably have some checklist somewhere. Okay, talk to the CEO, see if he has sense. What was a checklist like if you're going to raise funds for for a company?
Yeah, I mean, it's actually a very good question. I think one of the things is to understand what stage the company is.
Yeah.
So is this like a new company? Like you've literally just started?
So
You
let's
don't
start
have
from I think it will be hard to describe for pre-seed because that's very unstructured. Let's say Series A, for example. They already have a product running, they've made some money.
They have a couple
They want
hundred
to-
users.
Yeah.
I mean, exactly. And so like when you're going to like Series A, you're then going to like priced rounds, right? At this point in time. And then like there's certain metrics that you need to meet to like certain sort of checklists, right? Like that goes into like the Series A funded round. And obviously at this point in time, you have a product, you've tested like your product, you found product market fit, you know exactly who your customers are, you know exactly what your customers want. And now you're looking to like, obviously raise money. What some people do, or like what certain sort of companies do, and it's something I might also want to recommend. I might recommend is you look into like your existing sort of cap table. So who are the investors that have basically worked with you from like pre-seed or like to seed? And these kind of investors that would also do like a potential Series A, give you capital, or do like a Series A investment for you, and then you can start by speaking to them, right? Otherwise, you can then start reaching out to like actual Series A investors, like investors that invest are like at that stage. You can start to reach out to them with like your sort of pitch deck or whatever it is, like your marketing materials, and then see who replies to you and like who gets back to you. Obviously, at this point in time, like I want to imagine that at Series A, you have someone. So like the CEO or like the founder is not the one who is doing this process. You probably have someone on your team, probably have maybe like a CFO or someone who is like in business development or someone who is like, corporate development, who is then doing all of this outreach. So this person's work is basically to help us raise money, so that you can then focus on like actually like building whatever product it is, or like, basically running the company and running it efficiently or effectively. But again, it would be just reaching out to like firms who do this kind of investment. You might want to start with the investors that you currently have on your cap table, or potentially reach out to like new investors.
Okay.
Yeah.
And so on your own end, if someone reaches out to you, how do you start and how do you go through the entire process?
I mean, so like if hypothetically someone was to reach out to me, and by the way, I've not done like any sort of Series A investing before. So I've done more.
Maybe you can start with Inside the Techosystem.
I mean, yeah, obviously, like you guys, by all means, reach out. By all means, reach out. Yeah, and so I suppose, so if one were to reach out to me, because I'm actually I'm actually in a community where we get a lot of this sort of inbounds as well, like firms reaching out to say want to raise money, and so you would probably go through like the sort of whatever they've sent to you. If someone reached out to me and then says, "Oh, I'm doing this. We are doing about $1 million already, like an ARR. We are looking for capital to potentially grow, to expand into like new markets. We currently have, say, 50,000 users of our product. We are growing at, say, 100% month on month, or like year on year, or whatever it is." And they come with all of these solid metrics. And if it's, say, like an industry that I really understand, so let's say like fintech or like wealth tech or asset management or something, I'll potentially just get on a call with whoever it is that's reached out to me. If it was the founder, it would be nice to get on a call with them to really understand why they are looking to raise money. you know, like what they are looking to use the capital to sort of achieve. So really understand like what that growth story is looking like for them. I also, again, maybe because I'm a banker as well, I'll do a bit of benchmarking before ultimately like investing. So like benchmarking to see, so you are in this industry, how many people are in your industry at the moment? Where are you sort of ranked in this industry? How much, like what's your, like how much of the market have you been able to successfully capture? How much more is there to be captured, I suppose? And so really just really going through the numbers, going through like the users, going through like what, and also like their products as well, to really understand like what that capital will be doing. That's how I would personally analyze it. And this is, I suppose this is from like the sort of advisory perspective. That's how we also help them structure like their equity growth story that we then share with investors.
And then is any part of it influenced by how much returns the investor might eventually get?
I think at the end of the day, yes, because investors, by mind you, are not investing their own money. They're investing like their own investors' money, right? And so like they need to return returns to their investors. And
so wait, investors have investors?
No, it depends on how you structure it. So if
you're a private equity,
I mean, think about it this way.
So if you're a GA, GP, sorry. If you're an LP, then you're a direct investor. But if you're a GP, so this general partner and limited partner,
English.
Right? That's okay. Okay. For private equity, at least, right? There's someone managing people. So a lot of people put in money together. Okay, we want to invest, and then there will be a couple of people who would actually take that money and invest. So I think he's talking about the people who would manage the pool of funds, not the people who put the money. Right?
Okay. Yeah, but like you just broke it down. So the way I would think about it is, say, Chuka, you've got, I don't know, like you've suddenly come into like $100 million. Like you just woke up and then like there's $100 million in your bank account. And then you're asking yourself, so what do I do with my money? Right? Like I need to sort of invest my money. But you don't want to open like your own investment shop, right?
Okay.
But you want to gain exposure into VC. You want to be able to do VC. You also want to do private equity. You also want to do hedge funds. You also want to just invest everywhere because you want to like grow your money as much as possible. And so what you can then do is you can then look for like VC firms, for example, and be like, this particular VC firm invests in founders that are like this particular VC firm invests in like businesses that are very environmentally conscious, that are, like focused on sustainability and are very climate friendly. I am passionate about like climate investing, but I don't know a lot about it, but I want the future. I want sort of the world to be a better place for my kids. So I'm going to put $10 million in this VC firm so that they can invest in a bunch of businesses that do climate investing. Right. You can then put like another $20 million in, say, another VC firm that is investing like in AI companies in Africa. Like that VC firm, all they do is look for like companies doing AI stuff in Africa. And so if they see fintech, they will not invest. If they see, what else? B2B SaaS, they will not put money. But if they see AI, their ear is going to stand up. They're going to invest there. Right. So you can then put $20 million there. So those are, the kind of people that you probably call like your LPs, right? So like they are the ones that would then like they then give money to like these sort of VC firms, and then those VC firms are now the ones that would then go and start looking for companies. Money. Yeah, so you have to so they have to return money to you at some point. So like after like every year or like after 5 years, they have to like give you a return for the money that you've given to them to invest.
So there's a contract you sign and whatnot, like.
Yeah, like there's like an entire process, right? And so the same way companies look for VC investors to invest in their company is the same way VC investors also go and meet like people that have money to invest in their funds, right?
Yeah, okay.
So, and that's why you see news like things, I don't know, like these guys, what they call TLCom, is it TLCom or TLG? They recently closed like a $154 million fund, right? Like early stage venture fund, I think. So like that's like a fund. So they went to meet investors, they met like pension funds, they met like big asset management firms, right? They told them, oh, we've invested in like 20 or 30 companies in the past, or, whatever it is. We've made XYZ return on our company. So we have a track record of delivery of investing in good companies. Now we are looking to raise $154 million. How much can you commit into our new fund? This new fund is going to invest in women-only founders in Africa.
I see.
Right. And so the same way founders will go and meet like VC firms to raise money, same way VC firms would also raise money. That they then come and invest in the founders as well.
Okay. So my question is, do these people, the people giving money, do they know what companies the VC firm is investing in? Like, do they get a notification on their phone like, oh, we're investing in this company? And do they have a say in the investment choices at all? Or it's just like, we have your money now, that's it?
That's it. Yes. Like our firm, our firm has a mandate. Our mandate is to do XYZ investing. So obviously before those guys invest in the VC firm, they would have done their due diligence as well. Similar way before the VC firm invest in your company, they also do their own due diligence, right? To say like, do you not raise money today and then tomorrow you've gone to buy Benz and company has right? So like it's the same way they would do like their due diligence as well. They would do their due diligence to understand like who are the partners of this fund, what is their track record, what have they done before, right? Where have they worked before? Who are they? Do we trust them? Like there's a lot of sort of due diligence that goes into the process. But more importantly, as the firm or as the fund is being used, the VC firm, so VC firms are like investment firms, PE firms, VC firms, many investment firms, they have what we call investor relations team. So this investor relations team are usually guys who are in charge of fundraising. So they are the ones that will go and raise funds from all of these investors. And then those guys will then send like portfolio reports to like their own investors, say like quarterly or or semi-annually or annually. So in the portfolio report or like the portfolio performance review or whatever it is, they can then explain to them, out of the, say, $200 million that we raised last year, we've been able to deploy $50 million into XYZ company. We are looking to deploy the remaining $150 million over the next 3 years into blah, blah, blah companies. These are the companies in our pipeline, that is companies that we are currently reviewing that we haven't invested in yet. And then they will send that report to like the investors like on a regular basis. The same way the founders would also send like their own sort of company report to like the VC investors on a fairly regular basis as well. So it's the same chain. It's just like different people playing in different buckets.
What's the average size of a deal in, let's say, in Africa compared to Americas and in Asia?
Oh man. Africa is honestly, I feel like the word is very minute. It's like very small, very tiny, right? Very literally like just very minute. When you compare, so you see like many sort of obviously America is like a powerhouse of like investing, right? Like those guys raise a ton. You see people raising like they have so much money. You see
they have money in that country. No, that country is rich.
You really cannot compare. But like this is actually a very good question and a very important question for like many of the founders that I speak to every time. It's like they see like American companies raising like $1 million per seed, or raising like $2 million, $3 million a seed, and they're like, I want to do the same thing. Our products are the same, very similar, blah, blah, blah. I want to do the same thing. I'm like, okay, do it. If you can, right? Do it. But like the other thing I also tell them is before you actually start to raise money or before you start to do any of these things, like ask yourself as a founder, what do I want to get out of this process? So I am building a company. Do I want to build this company and then I want to own this company for life? Or do I want to build this company, I want to own it for like the next 5 or 10 years? And I want and sell.
I could imagine.
Or do I want to build this company and like just want this company to like be sustainable for me and then I can have someone else come and take over? But like I will still be the owner. But like, you have to think about what you're doing before you actually start doing it. Because when you understand where you're going to, it can help you, it can allow you, or it can guide you with certain things like fundraising. Because here's what happens. A lot of companies raised so much money in 2020, for example, 2020, 2021, 2019. They were raising so much money. They were raising like 20, 30, 40, 50, $60 million valuation in Nigeria or in Africa. And they were doing like businesses that are not, you don't have as, I mean, you have maybe like one or two global players, right? Doing what you're doing. And so if you wanted to do an exit in 5 years, who are you going to exit to? Because if you have like one global player, say you have like, I don't know, like, let's say like the global player in your field, for example, let's say just hypothetically is Microsoft, right? If Microsoft wants to, and now like there's like 10 of you doing the same thing in Nigeria or like in Africa, doing something similar to what Microsoft does, hypothetically, right? Now all of you are going to raise like 70, 80 million dollar valuation. You're like, yeah, we've raised so much money. Now it is 2024, 2025. You are looking to potentially do an exit. Even if Microsoft was going to acquire like one of you guys, it's just going to acquire one of you. So what happens to the remaining 6 of you? What are you going to do? Who is going to acquire you in Africa? Nobody. You are too expensive. Because now, like, the market you had before is no longer there. The users are no longer there. They've all moved to, like, OpenAI. I don't know if you get my point, but, like, you have to be very sort of strategic about the things that you do.
I was also going to ask about why the numbers are small. Is it because our economies are smaller, or is it because the potential return is not going to be big as well? So, for example, if you raise $1 million in the US pre-seed, and it's an American company that would sell products to Americans, right? The growth potentials are huge. But if you do the same for a company in Nigeria, where, for example, the number of people who earn more than $1,000 a year is less than 3 million or so, which means that your TAU, total addressable market TAM or something like that, is so small that, okay, let's say you grow. Let's say you even have 100% market share. It's not going to be enough money for you to return to the investors, like to 10x your investment or something. Is that part of the reasons why our deals are much smaller, or just the fact that it's Africa?
I mean, yes, good question. I think it's a number of things. So like you rightly mentioned, the market is sort of fundamentally poor in some way. So like from a disposable income perspective, people are only willing to pay so much for certain products and services, right? So if you were doing, I don't know, like if you had like a total addressable market of say, whatever it is, say $100 billion, right?
Yeah.
Globally, of that global sort of pie, the Africa sort of pie or share of that pie might be say 2%, which is going to be like $2 billion, right? And then that's like total addressable market, right? Just more broadly. But then like how many of those people, like how many people in Africa like would be able to then can you realistically capture, right? So I think like there is a bit of the market is a lot poorer than like more sort of advanced markets. I think the other thing we've also seen in recent times as well has been the gradual erosion of like the middle class population in many African countries. And this is obviously like due to a number of things. So obviously macro issues in like a lot of the major African countries, Nigeria, Egypt readily comes to mind, and even South Africa as well, where we've seen significant currency devaluation that has eroded sort of purchasing power of like many people. And so now people have to like decide between doing X and Y, or buying this and buying that, or paying for this and paying for that, because now they are faced with like a lot of now they are earning significantly less than what they used to earn like in previous years. So like we're seeing like a lot of that macro headwind also like just impede into purchasing power and like the ability to spend or pay for certain things of like so many African consumers. And even for businesses as well. So like imagine like you're a business paying for paying for AWS, right? When dollar was what, like, 500. And now like dollar is at what, like, it's like 1,005 or 1,000. Like your cost has basically doubled or even tripled, has basically gone either 2x or 3x, in cost. And so for many people, they are constantly looking for like alternatives, like cheaper alternatives, or like way cheaper things as well. And then if you had raised money in 2020 when things were still very strong, where like the underlying macro fundamentals were like very strong, right? Where people had all the money in the world, everybody could pay for things, buy things, and now good times basically. And now no one is able to do it any longer. Then like suddenly like you are then very challenged. So I suppose like for many African startups or for many African businesses, you have to navigate macro headwinds that are completely out of your control. Then also people are just like people are just not as rich as like their counterparts in the West. Like you don't earn as much as they do. You don't have as much disposable income as they do. And then you also have to pay for so many things. So like as an African, like at least as a Nigerian, like you're paying for your light, you're paying for your security, you're paying for your own infrastructure as well. For many of the guys in the West, like you don't have to pay for these things. So they have like a lot more, income to like spend on certain things. So I suppose like when you consider like the macro headwinds like people face, and then you consider like the significantly like lower disposable income, then investing just doesn't seem as profitable. Now, for companies that have been able to really hack the African market, that have been able to like innovate, like in spite of all of these headwinds, growth for them has been like phenomenal. A lot of the fintech players have been able to like, they really understand the market. They've been able to like build bespoke, innovative solutions that really work for like the market they're in. So think about guys, what's one of these guys that in Nigeria, this Money Points, for example. Look at what they've done. Look at the guys at OPay. See how, like just innovative that is. The guys at Safaricom as well, like in Kenya. Like all of these things, so what's it called? M-Pesa in Kenya. Like all of these products are like, extremely innovative products, and you can see like growth or like adoption of this product has just been like, like phenomenal, versus like other players in the market. So I suppose there are like buckets of like opportunities that deliver like 10x, 20x, 1,000x, 100x returns. But like those are like true unicorns. Like it's not something you just find, just randomly, because again, things just keep changing. People are just not as rich. And so investors would rather invest in like where they get more returns, right? Like, at the end of the day.
So I know we've been talking about investing, like, investors put in their money, but now I want to actually talk about returns, right? So there's, I don't know if you know the Peer Africa. Yeah. Okay. So I think they're a fintech company that recently shut down. But there's an interesting news I came across recently saying that they are returning about $350,000 to their investors, right?
Bro,
And
wait.
this is not something you hear all the time, even for American companies, even for international companies.
Yes, they did.
Wait, are you serious? Oh, I wish I didn't have this information before speaking. Oh my goodness.
Is it the guys?
Yes.
Is it the guys that are burning like $20,000 or $30,000 a month?
So they're burning 17. They burned 17K a month, and what? They only made like $650 a month or something like that.
Yeah.
No.
Yes,
and then
are you sure it's the same company?
Yeah.
And then I think, and if it's that same company, like I also heard that like the only reason why they're able to return this money is because investors are going to go to court or like, do something. Yeah.
Okay, you know what? All I saw in the news was, they're returning this. And in my head, I'm like, good news. Because I never see this in the news. I never see, investors are going to get some money back. This is interesting. I need to do my research. But like, what are your thoughts on this, Ade? Because first of all, this never happens. Like, you can put $5 million in a business and you are bound to lose it all if things go south, right? That is crazy. I don't think I'll be able to survive that, right? So like, it's crazy. $17K a month.
Yeah.
Imagine, are you serious?
Yes,
and they were operating in Africa, in Nigeria.
Yep. But like,
that's true.
but remember, like that is fundamentally like the VC operating model, right? It's like throw a bunch of spaghettis on the wall and then expect that one of them is going to stick. And the one that stick is going to be like the nicest spaghetti, right? Like that's like the model. So it's like the 5 million, like you will not be able to put $5 million, but like for VC firms, they're more than happy to do that. Put that like in a bunch of like companies. At least one of them is going to work out well, right? And like the one that works out well, the expectation is that it must be able to return the fund.
The exact fund or over the amount that they put?
I mean, ideally, like over the amount, like as much as possible. Like the upside has to be like unlimited. But like anyone that like basically works out, if he returns the fund, then like at least they know at least one of their investments was able to like return their fund effectively. And but like in order to get that, in order to maximize your chances of getting that one investment that returns the fund,
you have to try
then like
many different
things, right? And so if you have like 2 or 3 firms returning the fund, then like you're good, like you're great, like you're doing so well. And that's why like a lot of these American big sort of VC players have all of these successful investment. Because again, remember, like it almost even feels very like it also feels like a self-fulfilling prophecy. Because if a certain fund invests in a company, and then, even if that company is really, really struggling, but they manage to like do something and then they get to Series A, right? That fund can be like, we've done our bit now, right? Any company that wants to come and invest in like at Series A, right? Or like at that growth level, or like at that growth, it can be like, this particular VC firm invested here. So they clearly saw something before they invested here. So we'll be willing to pay X, Y, Z. And then the VC firm that invested early is going to just make their own return and then just get out. If they are no longer comfortable in investment, or like they can, effectively stay, like whatever the case is. But it almost feels like a sort of like a self-fulfilling prophecy, at least like in certain places. But so like the VC firms are investing as much, like in as many companies as possible to maximize their chance of success. And then the expectation for them is at least one of these firms or one of these companies would return, like the fund, and then we are good. So like that can basically cover for like all the other losses that we've made across the other investment. But yes, like, again, I think that people understand that, like, or like investors understand, like, there's a lot of risk in investing in businesses. Because the truth is, you could have invested in a crypto business in 2020. Many of these many of these wallets, many of these businesses, at the time, they were extremely, like, they made sense. Like, all these Web3 businesses, like, a lot of people were using them.
Yeah. It was
that was like the future. Then, right? It was literally all the rave, right? Yeah. So you're like, this is the future. Like that NFT. These guys are like an NFT wallet. Like NFT is the future, right? So it's like, and you're just thinking like, okay, wow, yes. And then you're seeing people just like all over my Twitter. It was NFT today. I know people were even saying like, if you don't buy NFT, like your children will swear for you, like because like you're not thinking. They were like, "Oh, what are you doing?" Right? It was all the rage at the time, but like now, like some people can slap you if you mention NFT. Like, are you okay? Do you know how much I lost? Trading NFTs.
Oh man,
it's a very, very interesting place to be. It's really interesting.
Yeah. So speaking of raising money. There are many ways to raise money, right? You can raise money by having investors. You can raise money by stealing money. I wouldn't recommend. But you can also raise money by lending. So what are your thoughts on leverage versus equity? From the investor? No. Well, investors are not involved in leverage. But from the perspective of the founder, should they ever consider leverage instead of going for equity? I know Thrive at Greek, for example, they raised money through loans, something like that, instead of equity, which I think makes sense for their own use case. So what do you think about that?
Yeah, no, I mean it's a very good question. So I just from like a sort of core finance perspective, we often say like debt is cheaper than equity, right? Because like with debts, you're paying down whatever it is, say like you're good at like 10% interest rate, you pay down, once you pay down your debt, like that is it. The person that you are paying the debt to doesn't have any equity participation in the business. They do not benefit from like any potential upside that has come from like the pay down of that debt, right? And like from whatever profit accumulation is derived from the benefit of paying down the debt, or like, you know, acquiring the debt, or like using the debt in the business. So like it is sort of cheaper to like use debt and equity. And I think that sometimes, or like for many of my friends as well that are also like building companies, I tell them to consider like debt as well. Because again, as a founder, if you know what you're trying to optimize for, then that can really allow you to think about the best way to go about raising money. So say I built a company and I'm like, I want to have, so, okay, I mean, we are like two co-founders, Emmanuel and Chuka. You guys have built, I don't know, like some AI company, say like AI for content creators
Podcasters.
or for podcasters, right? And now like all of a sudden, like everybody is using like the product, right? You guys have, you built something that makes so much sense. You have a lot of, you have like 2,000 people, like 3,000 people on like your wait list. They're all willing to pay, say, $500 a month to use your product. And then you have a lot more people also indicating interest. And then from like your maths, you can see that, oh, actually, if we are able to convert all of these 2,000 people, right, and they are paying $500 a month, right, that's like $6,000 per person, right? You know, like this is a lot of money for us. We don't need as many people to like scale our business, right? And we don't want to do this thing for like so many years. We want to do this thing for like 5 years, make our money and get out. So should we actually raise money? Maybe not. Maybe we can actually bootstrap for like the first 6 months to 1 year. And then after like 6 months, when we've seen sort of how our revenue is growing, how, you know, our cash flow is, how our business is doing, we can then decide if we want to raise additional money. But say after 6 months, you're getting like consistent cash flow, like users have grown from like say 2,000 to like 10,000 people, and you're all paying like all of this money. And then you're looking to raise, and then let's say you then need to say $500,000 to then expand, maybe hire like 2 or 3 more solid engineers. Some people might decide to go and raise money from investors. But if you guys are saying we actually want to keep our equity at 50-50, we don't want any form of dilution. And even if we want to dilute, we are only looking to do like a 10% dilution max. Because in the next 5 years, we are looking to be able to sell this business at, say, $10 or $20 million, so that both of us can walk away with like $8 million each, hypothetically, right? And then you can then decide to approach a bank and tell the bank, actually, you know, do you want to borrow $500,000?
Yeah.
Here is our historical cash flows. Here is what is going to look like over the next couple of years.
That's the part about leverage
and then let's talk.
Borrowing money. You kind of need a history, or you need something to back up why you need that money. Meanwhile, in investing, you can just sometimes stop.
Oh yes, you definitely do. Exactly. So again, like it also depends on like what you're doing. I mean, sometimes like certain VC firms or like certain investors will also do. I mean, some investors also do debt. Actually, like a number of investors probably do debt. They will give you debt, and then sometimes like these debts are also like convertible debt. So like debts that might convert into equity in future. If that is something that you want, it's something that you can always like have the conversation with them, negotiate with them about. Otherwise, you can just actually just approach like an actual like financial institution, and then just do like actual borrow at say like a fixed interest rate or variable interest rate, whatever you're comfortable with. And then as long as you've got like an history, you have like consistent cash flows, they can see that you guys can actually meet your obligation, like your debt obligation. They will most likely borrow you. And then you can use that to like finance your business or run your business. So again, once you know what you want to do and what you're optimizing for, it makes it a lot easier to approach this thing with like it just makes it a lot easier. And I do know that for many technical founders, they want to focus on like just the technical bits of like whatever they are building. They don't care about finance, about operations, about HR. They don't care about that. But if you're a technical founder, then you want to look for like maybe like a non-technical founder that has expertise in these other areas, because they are equally as important to the success and growth of your business as much as like the actual product is. And so when you guys have this conversation very early on in the process, then you can focus on building what you want to build and actually building a company. Like, as long as you know this is what we're ideally optimizing for. Like, just don't go about raising money because everybody is raising money. I mean, so it is always obviously very good to have, you know, investors on your, like, in the company, advising you, helping you, giving you money. But like, if you don't need them, they're like, you don't need them, right? Like, if you don't need to raise money, then you don't need to raise money. You can, you know, borrow money to like, to scale your business. You can also raise money if that's something that you guys.
So let's go back to investment banking for a second. So you're let's say in Bank of America, right? They have many clients that they're raising money for, and it's possible that some of those clients are competitors. Is there a case where is there such a case where you're raising money for two guys in the same industry in the same country? Is that a no, or that's something you can also manage? So okay.
No, that's totally fine. Like,
they don't have to know. Okay.
They don't have to know. Actually, so the way it works is this. So like, just for context, the way it works is this. Every project has like a code name. Yeah. So 3 of us might be on the same team, but you would not know what I'm doing. Oh. You might actually pass in fact, you would even sit down beside me. So I was working on the project one, like, last year. It was this super high profile project. My seed partner, I was in that project for like how many months? He did not know. And then it got announced, it was on the news. I was like, and then we sent an email. I was like, wait, like, was that what you've been doing all this month? I was like, yes. Like, nobody knows because you basically have like, you know, like code names for all your projects. You have code names for even the clients. So say you are working for, let's say, let me use, what example can I use? Let's say you are doing a project for, say, Shell, right? And then you can maybe call Shell, I don't know, what can I use? Cedar. Cedar as like cedar, like the wood, right? You can be like Cedar. You can be like Project Cedar. And then the actual client, which is called Shell, you can call that one like Malta. So on the call, you'll be like, so like on our call with Malta the other day, like no one is going to understand what you're saying because like they don't know it is Shell, and you don't even have like the logo of like the company.
And I guess like, on the company side as well, they wouldn't tell their own competitor that they're raising money from X investor. So it's like a really, really
obviously like
game. Interesting.
No, obviously like they won't do that. Yeah, I mean, like it's ultimately private. At least for
top
us, like
secret stuff.
At least for us,
I like it.
It has to be confidential, right? Like this kind of processes, because you don't want to jeopardize like the process by like, you know, like everything getting out there. So like you do have to do that. So
the moral question is, why are you investing in two companies that are going to compete? Are you are you a sadist?
May the best man win.
No. Think about it this way. Think about it this way as an investor. You have invested, there are like 5 companies in an industry, major companies in an industry. You've invested in number 4.
Yeah.
Right? Number 4 is doing really well. They are growing. Actually, let me use GT Bank, Access Bank, Zenith Bank, UBN, like Unity Bank, for example. Say, and First Bank. You invested in First Bank. First Bank is like number 5. And then they are number 5 when you rank like top 10 banks in Nigeria. And then the gap between First Bank and, say, GT Bank, that is number 2, is like, say, $1 trillion in like total assets, hypothetically. But then First Bank has like, so like the gap is like 1 trillion, hypothetically. First Bank has, say, 500 billion in total assets. And then they are number 5. And say number 4 is UBA Bank. They have like 800 billion. And you're like, okay, if I combine both First Bank and like UBA Bank, or if I buy First Bank, I grow First Bank, I can also buy UBA Bank as well, right? Because I have the money to buy UBA Bank. And then if I buy those two banks, I can then combine them together so that they can be number 2 ahead of GT Bank. And then the only person that will be in my way is going to be number 1, which is Access Bank that has 1.7 trillion or whatever it is. But like I already have like 1.5 or 1.3 or whatever the number is. And then like in a few years, I might be able to get to number 1. Right. So like sometimes investors would acquire sort of competitors with the hopes of like combining them at some point if they've seen like potential synergies that can be generated.
I just imagine being a dad, and then you have 2 sons. You watch them fight and say, yeah, come together. Don't fight again.
I mean, ultimately, exactly. Like that's the thing, right? Like, so many investors do it. Like you see a lot of investors doing that. Also, you realize that many firms or many VC firms or many investing firms usually have like focus. So many firms are like focused on like, say, real estate or infrastructure, or say like fintech, or say energy, right? I mean, if you're focused on investing on like one industry, like there is no way you will not end up acquiring like competitors or like multiple players in the same vertical within that industry.
Yeah,
at the end of the day.
That makes sense.
Yeah, so that's what they usually do. But yeah.
So in your experience, what are some of the riskiest sectors to put your money in Nigeria?
I don't have any experience with that.
I think you already mentioned it. Crypto.
So like the way you told us, but like crypto is also almost like fintech, right?
No,
in a way.
Don't stain the image of fintech, please. But yes, technically,
I'm not going to say anything. But like I watched. But like, do you remember? I think Emmanuel, you were the one that sent me this video of JP Morgan CEO. Like he just goes around saying,
I was actually shocked at his answer. I was really shocked.
Ever exist, right? Like he doesn't hide it. He's very, very straightforward when like his relationship with crypto and how he feels about it. And I mean, he doesn't talk about the entire sector, but he says like something like, I'd say coins now, right? He doesn't really believe, like he says it's not real money, right? And JP Morgan,
they are the biggest,
and
right?
Chase, like they are one of the biggest banks in the world.
Yeah,
so
the biggest.
If they are the biggest, right? So I mean, if they are leader, or if they are the head of the bank, things like that.
To be honest,
I mean, he could be wrong. That's actually, I think it's something to listen to.
Quite the opposite, because he's the leader of the biggest. What's it called? Exactly. Exactly.
Like the people that try to shut crypto down.
There's no reason for him to
I get it.
Anyway. Yeah. So.
I think that when so my own view is I don't have any view of crypto or whatever it is because I also cannot give investment recommendations or investment advice. Like, but what I would just say
is I did I said it on
ITQ. I should go I should go and sell my father's house and put the money in X, Y, Z. So please, nothing. But like, I suppose the reason why a lot of traditional financiers are very much against crypto, and many people will say, "Oh, they just don't understand cryptocurrencies," is cryptocurrencies do not really have any fundamentals that really drive them. When you think about it, I suppose the only fundamental that potentially drives them is just like maybe global instability or like sort of global risk generally. But think about it: equities. If a company has done bad, share price goes down instantly. Ideally, right? They did not meet like revenue expectations. they made a loss. People were going to sell the shares. Like that makes sense. Same thing with like bonds as well, right? Like when interest rate is going up, right? A lot more people want to buy like bonds, right? The price is going to go up and then the yield is going to go down, right? Because like there's an inverse relationship with that as well. So like there is like fundamentals that also drives that particular market. But we like same thing with energy, oil prices. When there's like global instability, say company A bumps company Y, oil prices either go up or go down, depending on like which country is affected. Gold, when again there's a lot of instability globally as well, a lot of people start buying gold because gold is seen as like a safe haven. So in the event that like the global financial system crashes, hypothetically, if I have gold, it means that in future, if people start to acquire wealth or people start buying things, they want to do luxurious things, I can sell my gold and make money. So people start buying gold again. So a lot of these things have like fundamentals that drive them. But when it comes to cryptocurrencies, it's down. It's
Bitcoin to the moon.
So what really drives it? So like Bitcoin, do you understand? Like what is like why is it going to the moon? Like what is driving it? ETH is doing
I'd say it's vibes. It's just vibes, man. Don't ask questions, just vibes.
So I suppose that's one of the reasons why a lot of traditional financiers might express very strong views against cryptocurrencies because they partly do not understand what drives it, and they are just as confused, like what is driving this thing. But yeah, like young people, we don't. It's like it's going to the moon. It's going to the moon. I'm just going to buy it. Like I'm not going to be asking questions. Anybody's making millions. I'm going to put my money there.
So you've really.
Yo, I'm sorry. We need to make that a quote. We need to make that a quote. We're making millions. You're asking questions.
So it's really interesting the way you put it, like the fundamental thing. When you have crypto bros on your WhatsApp, you would know because they always post. So whenever they post, I'm like, if everybody was to do this crypto thing, they're like, what are we really doing? Okay, let me give you an example. With real money, right? If you're doing investing, for example, let's say you invest in sustainable businesses, right? You know that the world is going to get better, and you also get a reward by making some returns. For crypto, like, how does that work? Like, you sell to someone, somebody buys at a price that is too high, or it's almost like this theory of the greater fool. No, the greater fools. Okay, yeah. The greater fool and zero sum game,
it's
right?
A zero sum
There's always going to be a fool that will buy it at a higher price, So it's really interesting that
ultimately.
Exactly.
When it gets to the top, there's someone that is waiting at the top to buy it just before it goes down.
That's crazy. Yeah, no, I don't mind.
Man, crypto bros are going to come for us, man.
Yeah, so let's talk about products.
I beg.
Let's talk about products. So you mentioned a lot about how companies raise money at different stages, pre-seed, Series A, and all of this. And of course, for them to be able to raise money, it means they are expanding, they are growing, right? So what do you think, or let's say it this way, how would you describe the challenges of each stage of growth for a company? So let's say I start a company today. My first goal is probably to build the product and eventually get the first set of customers. And eventually I want to maybe expand my team and grow and make my operations more scalable. So can you tell us how it works from A to, let's say, I don't know, A to B, A to D, for example. So from a size of 2 founders, for example, up until a company of 500. How would you go through each stage, and what kind of challenges should a founder expect in those stages?
It's a very good question. So I would take it back a little bit. So ideation, you literally thought about, you're just thinking about your product. You have now, what's it called? You have like your co-founder, you found a co-founder, you guys are building a product together, and you want to raise money, right? You probably start by raising money from like your family and friends to like a very small, tiny thing around, say raise like 100K to just start building the things that you need to do. And then you maybe reach out to people on Reddit to see, guys, I'm building XYZ. Does anybody find it helpful? To basically test out what you want to do at that stage. And then say you get like overwhelming, like very good response on all of these platforms, and you have like a wait list of people who are willing to use your products. You then do like a launch, right? And then you want to now obviously start raising like a seed round to ultimately build your product and really test the market like fully. At this stage, then you'll be thinking about getting more people to use your platforms or to use the products. So getting a lot more sort of sticky customers that are using the products, a lot of feedback from them. Ideally, you want to, you don't even have as much money, but you want to see how much you can do with very, very little marketing spend or even zero marketing spend, if anything at all. So how many people are using my product? What are they using the most? Like, what kind of feature do they like the most? Like, you're obviously like doing a lot of iteration, getting a lot of feedback from like your customers or the people who are using your products, and then also trying to reduce churn as much as possible. I think it's at this stage as well that you also start thinking about like how much it also costs you to acquire like a customer. So your customer acquisition cost. You also want that to be something that is extremely, like, you want to be very efficient with how much it costs you, because again, you don't have as much money, right? So you want to start thinking about like efficiency. It might not be a major thing, but it's something that you want to like start to think about, at this sort of seed kind of stage. And then as you get into Series A, where you then have customers who are actually using your product and you're paying for your product, you are making, say, like $1 million a year, like you're doing very good, like in total, like either like in total revenues or whatever it is, you're making very good money. At this stage, you don't have to be profitable, right? It's just, again, people using your product, people sticking around to use your product. So like you don't have as much churn. And then like the cost at which you're also using to acquire these people is also not like insane. So like you are keeping cost under control. You are constantly iterating, and then you're now starting to think about like how best can I sort of grow, say my user base, or how many people are using my product? Do I want to expand across geographies? Do I want to expand across markets? Do I want to make a pivot into like another product line, for example, like a vertically integrated product line? I suppose it's at this stage you can start to think about that a lot more intentionally, because now you have a bit of capital to do that. And then you already tested the hypothesis of like your underlying product. Like that one is there already. So you're just, getting that product better. You're like basically iterating on that product, making sure like it's a lot more efficient. But then you're now thinking about, okay, let us add other things, let us add other features, let us, backward integrate, let us vertically integrate, let us expand, globally, let us expand across Africa. You're thinking about like how best to price your product as well to like your customers. I suppose like there's just a lot more that is going on at like a Series A. Like you're actually now you're a company. Like you're basically like a company at this point, like at this stage. So you should have people in the right teams, right? You should have like divisions that are handling certain things, right? You're basically a company. And then as you progress past Series A to like B, C, D, and then like you are entering that very significant growth stage, it is now no longer about, you're still thinking about profitability, which I think is important, but like you're really thinking about like how to grow aggressively. And that's again to the point of like, how do we now begin to unlock growth? Like what kind of product? Do you understand? Like how do we want to grow? And at this stage, you don't want to be growing at like, you want to be growing at like 100%. Like you want your growth to be like full on growth, right? Insane growth that would even scare you. So you want to be growing, you want to be acquiring users like crazy. You want to be, like expanding to new markets. You want to be, you basically want to be like introducing new products. And it's funny because like you see companies like Flutterwave is like a Series D. Is it Series D or Series E? Like at this point, obviously like they are looking to like an IPO at some point in future. But you can see just how much they are growing. Like every other day, there's like a new Flutterwave product that is out there. But I suppose like what they'll be optimizing for now at this stage of their sort of life cycle is going to be profitability, because they want to go to the market to raise money from like investors. And so like those ones will be more concerned about how efficient have you been.
Yeah.
Right.
I mean,
so all
you've
of
been
this
at this for a while, so
exactly
yeah,
right. So like all of the growth,
where's
all
the
of this.
evidence?
Do you understand? Like all of this 200% growth year on year, this 100% CAGR 5-year CAGR growth that you've recorded. Like, where is all that money going to? Right. Like so. Like obviously, as you get more sort of senior in like this life cycle, the question is now then, how can you grow sustainably and efficiently as well? So like, how can you grow and then like also be efficient with like cost? And I suppose one of the things that I've done with like the companies that I've worked with and that I also currently work with is, although we're still very sort of early stage and like the very like seed for one of them, actually like seed I like 2 and then like pre-seed I like one of them, is we are not waiting until we get very senior to be efficient. We're effectively like injecting efficiency into our operations now. That is partly because I would say we are partly bootstrapped. So like we are not actually raising money for now. For the one where we are raising money, we are also like we have a goal in mind. Like we are not raising more than this amount because we know that we are not doing an IPO for sure. We want to do a strategic sale in the next 5 years. And we are looking at a sale between, I mean, not to give you numbers, but like a range of say 20 to 30 million is like the range we're looking at. We feel like there are a number of people in Africa that can actually afford to buy the product at that amount easily. And globally, there's like a lot more people that can buy. So it's like, yes, we're just going to build out this product so that in 5 years we can approach any of these 10 people to see which of them can buy. And in order to then increase our own sort of return, like from all of this work, is like, we're not going to raise any money because there's already like 5 of us doing this. So we don't want to get diluted as much as possible. So we can effectively bootstrap this and then we can do that. And then because we're bootstrapping, we have to be efficient. So we're not just hiring like, engineers because yes, we need to have like all these engineers. We're not just hiring like a PM, for example. Like all of us are finding ways to chip in. And we have to like be very, very like efficient in how we do things. So again, like this is how we are like thinking about it. I suppose like for companies starting out, you have to be like, take that 24 hours or 48 hours to really think through what kind of life cycle you want your company to go through. Like spend time building your product, but really take that time to like just sit down and be like, I want to do this thing 5-10 years. This is what an exit looks like for me. And then it should be like 5-10 years or whatever it is. And then it means that like over the next 1 to 2 years, I want to do this thing. So it means that like in the next 12 months, I need to launch. So I have 12 months to build a product. So I can launch in 12 months time. And then I can, just take that time. I mean, it might be a very idealistic plan for now, but like sit down, like just take the time to put pen to paper because I think it really helps you just navigate this things. But again, to summarize,
things into perspective as well.
Into perspective, yeah. But I would just say like starting out, optimize for growth and optimize for efficiency. So like, I would say growth is going to be anything from pre-seed. I mean, from seed, because pre-seed is just like traction, so you don't need to have like growth as much. But from like seed, then like start optimizing for growth. And then anything from like series A is then like aggressive growth up until whatever happens afterwards. But then as you go through this process, as you're optimizing for growth, also optimize for efficiency. When you're very efficient, you most likely achieve profitability.
Yeah. Man, Ade, if we keep talking, we'll stay here forever. So we're trying to round up the episode soon. But I'd like to, quite a lot about startups and growing and investments and whatnot. What are some of the signs that a startup is likely to succeed? Now, that means like when you see a startup, maybe you look at their process, or you look at how they started out. What are some of the green flags you see for a startup? especially one that is brand new, fresh, right? Because I feel like if you've been a startup for quite some time, you've had some success, and that's why you still exist. But like if one was just starting out, right? What are some signs that this is likely to succeed? And then what are some
This one will
signs
die.
that you see also that nah, these guys are not making it out the hood, man. Like what are some red flags you can immediately spot, like when you see a startup or someone building something?
It's a very good question. Like really good. I think for me, it's always like conviction. Like, do you actually understand what you're trying to do? And I suppose like you can get a sense of like a person's conviction like when you get on a call with them or like in the first couple of minutes. Also, and this is probably like a smaller point that I don't think matters. Maybe it's just because of my background in banking. Because like sometimes when I go to like a pitch deck, I can almost tell. Because sometimes like some people optimize for like very like glossy, great pitch decks that do not actually tell like any message. It's just a bunch of.
It's just a lot of
like,
words.
Are you being mysterious in your pitch deck? Like what is this? Like, why don't I understand what you're doing here? Like why send me a pitch deck if you're going to be mysterious, right? That's
I don't like that as well, because if I go to your landing page and I can't tell what you do through the landing page, I get so pissed. I'm like, what is this product? Oh my god!
Like, what exactly are you doing?
What do you do?
Are you? It is one of my biggest like sort of pet peeves. But again, this is just on this side. So, and then on the flip side of that is also sort of nonchalance as well. When people send pitch decks and it's just like reading with like grammatical errors, it's not properly formatted. It's just like it just feels like this is like an afterthought for this person. And in my head, I'm thinking like, if you're not going to spend the 2-3 hours it takes to go through what you've put together to raise money for your business or to reach out to investors, then like, how are you even going to run the business? And there's no excuse for saying like,
so funny thing is, I've actually been fortunate to see someone attempt to raise money. So when I was working for my first real company in Lagos, after school, yes. So I was fortunate to work as like the lead engineer. So I had to work with the COO, who was also helping with pitch decks to raise money. So I saw him, write all this stuff, and I saw how much effort it required, because he would come to me, how much does it cost to acquire one company? Sorry, to acquire one customer. I'm like, what does that even mean? I have to go and write some query, put some things down and all of that. Ask me, how much did we make last week? Okay, I have to go and write some query. So the process is quite tedious. So if somebody does it well, then obviously it's a sign that they really want to raise the money.
Exactly. Like, I mean, it's just like, just taking that time. I mean, and that's one of the things that one of the good things I learned in banking is, if you're going to spend, I don't know, 5 hours putting together like a pitch deck, when that pitch deck is done after 5 hours, spend at least 30 minutes just going through it, just checking that actually, like, what I put here, does it make sense? Or maybe have someone else go through it. And so if a founder cannot do that, then for me, it's just like, I suppose like it's a slightly small, it's a sign, because like it could mean the person just doesn't pay attention to detail, which means a lot of things will just sort of flow under them and then they will not realize. Or they're just very arrogant, right? They don't care. And you don't want like a founder who doesn't care, who is very nonchalant, right? So these are like some signs that like this startup might not work. And so, and conversely, if someone is able to do all of these things well, like pays attention to detail, actually takes their time to really explain what they do, that can be like a good indication, right? And then also like just conviction, like understanding the problem you're trying to solve and understanding the products you're trying to build. And being able to answer questions about the product. Do you understand what you're trying to do? And can you answer questions about this? Like, again, because again, you can also almost tell, when you speak to them or when you speak to people, if they really understand what they are trying to do and they understand like what it takes. So again, like that conviction is something that I would also sort of look at. Yeah. And then prior experience and maybe pedigree, I think is something else as well. So what have you done before now? where have you been before now? I mean, not really where have you been, but like really what have you done before now? And maybe partly also like where have you been as well? Like what have you been doing before now? Are you like an accountant that works in KPMG and now today you're like, actually I want to build this startup that flies to space to mine palladium from like one of those stars. It's like from where to where.
That's how they select ministers in Nigeria, because the minister of power is probably an accountant somewhere. I'm like,
somewhere. It's just
how is this person going to fix our problems?
So much mismatch. So like that pedigree is key, man.
Yeah, thanks, man. Ade, thank you so much for coming on the show. Like, I mean, I took a bunch of notes, and I have to go and visit my own pitch deck. Thank you so much for coming on the show. We learned a lot, and this was really insightful, and this was really fun as well. We usually close with one question whenever we have a guest, and that is, what would you be doing if you're not in tech? Like, if you never got to this level of investment banking or going ahead to work with different founders and products, do you have interest elsewhere? Like, what does your life look like without tech?
I'm honestly tempted to say I'll just be chilling. Like, I'll just be like chilling somewhere. I'll just be chilling. But like, if I'm being honest, like, I'll probably just be like a diving instructor or something. Like,
oh, nice.
I'll just do that. Like,
that's a very interesting answer. We've not had a lot of interesting answers so far. That's nice. So you swim and you dive and
I love being in the water. Like, I just love being in the water. So
that's crazy,
either like
for an African, for a Nigerian, for a Yoruba man.
I know.
I saw this influencer. He posted a picture. He posted a video of some of his friends diving into the water. Right, I think it was in America or something. And then he now posted his mother's voice notes. Inioluwa, what is this one? Please, I'm not there. Like, it's just crazy. Man, that's nice. That's nice. That's lovely, man. Man, thank you once again for coming on the show. This was really fun. This was really interesting. And wish you all the best. Wish you good luck in your future endeavors. And all right.
Thank you, guys. Thank you for having me, man. Like, this has been really nice. But thank you so much. Really appreciate it. And again, you guys are doing like great work. I'm actually I'm really impressed, honestly, like, because they're doing something for like Nigerians. Because I feel like when I moved out of Nigeria, like, my only connection with Nigeria was mostly like through like Tribe Africa and all of these startups I was doing. So I didn't really know a lot about what was happening like in other parts. It was just my guys.
Yeah.
Whenever anyone said the pitch deck, go through it. But I just didn't know. So like, this is actually very cool, man. You guys, cool stuff.
Thanks, man. We appreciate it.
Thank you so much for listening to this episode. We release new episodes every month. If you haven't yet, please subscribe to the show on Apple Podcasts, Spotify, or wherever you get your podcast. And if you enjoy the show as much as we do, don't forget to leave us a 5-star review so the podcast reaches more people.
A huge shout out to the amazing team that makes this show possible. This includes John Ayeni, Faith Idowu, Angela Adelowo, and Ukichukwu Nwachukwu. Connect with us on social media at Inside the Techos on Instagram and Twitter, and Inside the Techosystem on LinkedIn.
All right. See you in the next one.